Today, we're going to follow the money. We're going on an invoices journey through SAP to see how a simple sale actually turns into cash in the bank. It's maybe one of the most critical processes in any business, turning all your hard work into actual, revenue.
So let's start with that one big question. How does a customer's click on your website, or maybe a signed contract, transform into cash in your company's bank account? It sounds simple, but there's a whole journey there, and that's exactly what we're going to map out today.
Okay, think of this as our roadmap for the journey. Every single transaction has to pass through these 4 key areas. It starts in sales, then it moves to shipping, on to billing, and finally it lands in accounting. We're going to see exactly how these pieces are connected and how information flows from one step to the very next.
First up, let's take a look at the standard journey. You can call it the happy path, where everything just works. No errors, no complications. This is how an invoice is born in a perfect world.
And when you look at it, the process is just so logical. It all kicks off with a sales order. Then, once the goods are picked, packed, and shipped, an outbound delivery document is created. That delivery is the trigger for the invoice. And finally, all the financial details from that invoice get posted into accounting. It's a clean 4-step flow from order to ledger.
But this brings up a really important question. When, exactly, should you create that invoice? Does it make more sense to bill the customer the second they place the order, or should you probably wait until the goods have actually left your warehouse? Well, SAP gives you 2 main ways to handle this. On the left, you've got order-related billing. This is triggered by the sales order itself, which is absolutely perfect for things like services or digital goods where there's nothing to ship. But on the right, there's delivery-related billing. This only happens after the items have physically shipped, and that's essential for physical products. It makes sure you only bill for what you've actually sent out the door.
Of course, the real world is rarely that happy path, right? Things go wrong. So sometimes we need to take a detour to handle errors and corrections. What happens when a mistake inevitably pops up?
So just remember our baseline. In that perfect world, an invoice is created, the customer's account gets updated, and everyone's happy. Simple.
But what if you notice an error after that invoice has been sent and posted? Let's say the price is just flat out wrong. You can't just hit delete, right? You need a clean, traceable audit trail for accounting.
And this is where the design of SAP is so elegant. Instead of deleting anything, you create a cancellation document. Look at how it perfectly mirrors and neutralizes the original invoice. It posts an exact opposite entry in accounting, and, this is the really clever part, it resets the billing status on the original delivery document. This opens it back up, allowing you to create a brand new correct invoice, all while leaving a perfect, auditable paper trail.
But canceling an entire invoice can feel like using a sledgehammer to crack a nut. What if it's just a tiny error on one line item? Maybe you shipped 9 units instead of 10, or someone forgot to apply a discount. For that, SAP has an even more precise tool. The solution is called an invoice correction request. And what it does is, for each incorrect item, the system automatically creates 2 new lines. The first one is a credit to completely reverse the original wrong line. The second one is a new debit for the correct quantity or price. You can see it here for a quantity change on the left and a price change on the right. It's a really surgical way to make adjustments without throwing out the whole invoice.
Okay, now that we've covered the straight path and the detours, let's explore some of the more advanced scenarios. Businesses have all sorts of complex needs, so let's call these special expeditions on our billing journey.
So think about this for a second. How would you handle billing for something like a year-long equipment rental contract? Or what about a massive construction project that's broken into multiple phases? You can't just send one invoice at the end, and sending hundreds by hand would be an absolute nightmare.
The answer is billing plans, and they come in 2 main flavors. Periodic billing is for fixed, recurring amounts over a set period, exactly like a monthly rental contract or a subscription. The system just automatically generates the invoice every month. Then you have milestone billing. This is for projects. You actually link payments to the completion of specific stages, like Phase 1 complete or foundation poured. You only bill when a real-world milestone is actually achieved.
And that's the real power here. Billing plans completely automate these long-term agreements. They make sure you're billing your customers accurately and on time without any manual intervention. It's a total game changer for any business with recurring revenue or long-term projects.
All right, here's another special case for you. What if you need the customer to pay a portion of the total cost up front before you even start the work or ship a single product? We're talking about a down payment.
This process really shows how seamlessly SAP connects different departments. The sales team creates a down payment request right from the sales order. That request flows directly to the financial accounting team so they can track the incoming cash. Then, much later, when you send the final invoice, the system automatically remembers that down payment and deducts it from the total. It's a perfect handshake between the sales and finance departments.
So far, we've pretty much stayed inside the walls of our own company's system. But modern business is all about connecting to the outside world, right? So let's zoom out and look at the bigger picture.
This quote really nails the challenge of a modern business. Converge the internal and external billing data into combined customer invoices. Okay, so what does that actually mean in plain English?
It means this. Today, a single customer might buy a physical product from you that needs to be shipped. They might also buy a software subscription, which is just an order, and on top of that, they might be using your cloud services, which are billed based on usage data from a totally external system. Convergent billing is SAP's incredibly powerful solution to bring all of these different revenue streams, products, services, usage-based charges together onto one single unified invoice for the customer. It's absolutely essential for the modern as-a-service economy.
And this brings us to the final destination of our journey. Once that invoice is created with all its different charges, where does the money actually get recorded? That's the magic of account determination. The system uses this complex set of rules to automatically figure out which financial accounts to post the revenue to. Revenue from product A goes here, revenue from service B goes there, taxes go in this bucket. This automation is what guarantees that a company's financial reports are always accurate.
So let's just quickly recap the key stops on our journey. First, remember that billing can be triggered by either orders or deliveries, depending on what you're selling. Second, SAP has these rock-solid auditable processes for handling cancellations and corrections. We saw how billing plans can automate really complex, long-term contracts. We saw how down payments create a seamless link between sales and finance. And finally, how convergent billing is the key to unifying all your different revenue streams onto one invoice.
So I want to leave you with this thought. Your billing process isn't just some final administrative step. It's the engine that actually drives your company's revenue and cash flow. So looking at your own business, the real question is, how well is your engine designed?